All right, thank you very much, Wilson, for the very nice introduction. And thank you guys very much for joining me here this afternoon. I'm very thankful to be here in Hong Kong. We just don't get crazy weather like what we saw yesterday. I was really wondering what it was like to be dark in the middle of the day, and so I got to witness that yesterday, and that was very interesting. But as Wilson said, my name is Jeremy Wagner. I'm the lead trading instructor at Daily FX Education. For those that aren't familiar with Daily FX is the research and the education arm of FXCM. So the whole point of my role, and I've got a team of 4 instructors as well, the whole point of our team is to help educate clients about the foreign exchange market, how to identify trading opportunities, and hopefully help you guys grow your accounts. So that's the goal for today. Or the goal of my team. Now, for today specifically, I'm going to be talking about the traits of successful traders. And FXCM, we've gone through over 12 million trades over a 1-year period, and we found the behaviors of traders that help make them more successful. We found some behaviors of traders that made them a little less successful. And so I want to share some of that data with you here today. Also, next week, on Tuesday and Wednesday evening at the FXCM Asia office in Central, I'll also be doing a follow-up on some additional data and statistics that we discovered as well. And I'll have more on that towards the end of the presentation. Now, before we move any further, we've got to take care of some legal mumbo-jumbo. And basically, these next couple of slides are sharing with you that what I'm about to express with you is not a guarantee that you're going to be kept away from losing trades. It's not a guarantee that you will have winning trades. So therefore, any trades that you do make sure you assess the risk on your own accord, and that you're trading with risk-based capital, money which you can afford to lose. Also, I've got some strategies that we've gone through and back-tested, and therefore I have to have this hypothetical disclaimer as well that simply says the results that I've shown are back-tested, and past performance is no guaranteed of future results. Okay, so what is our objective? What are we going to accomplish today? Today, on the traits of successful traders, I'm going to identify for you the biggest mistake that Forex traders make, okay? Now, in order for me to build this case, I have to explain to you why we think this is the biggest mistake. There could be several mistakes that traders make. I'm going to share with you the biggest one and build the case for you on why we believe this is the biggest mistake. I've got 3 different types of scenarios that's going to help digest this for you. And then we're going to take a look at, now that we know what the mistake is, why is it that it happens? And then more importantly, we want to be able to walk away with on how to avoid it in the future. So let me just smack you right between the eyes. Here is the biggest mistake that Forex traders make. It's that they lose more money on their losing trades than they make on their winning trades. Said another way, Forex traders risk a lot to try to make a little. So imagine you had $1 million Hong Kong dollars and you're going to invest in a business. If you're going to take those $1 million Hong Kong dollars, would you want to make just a little bit of a return off of that? Or if you're going to put that much money on the line, you're going to want to see a much larger return. Well, taking that same concept and applying it to the Forex market, what we found out is that traders risk a lot just to make a little bit. Now the good news is all we have to do is simply reverse that equation in order to help bring the potential for stability to our trading account. Okay, so the first section here, I'm going to take the next few minutes and I'm going to describe for you why we think that this is the biggest mistake. So I'm going to build a case for you using 3 different scenarios. Okay. The first scenario here is, the first chart that I'm going to share is one where we have 13 of the most popular currency pairs traded here. What's important on this chart, what's important is this red dotted line moving across the upper middle of this chart. That red dotted line represents the 50% mark, okay? Now, as you can see, most of the data falls below that line. And what that represents is that more traders are losing money than who are winning money in a Forex account, okay? You've probably heard some statistics familiar like that out there, and you may be wondering, well, gee, why is FXCM putting on an event where in a market, a lot of people lose? And that's exactly the point, is we're going to share with you why a lot of people lose based on this data that we did. This data was taken from the fourth quarter of 2009 through the third quarter of 2010, so 12 months worth of data on FXCM's traders. Over 12 million trades were taken during this time frame. Okay, so most traders are losing. Let's move on to our next chart. What we also realized is when we break it down on a trade-by-trade basis, the blue portion of these bars represent the winning trades, the percentage of winning trades. The red portion of this graph represents the percentage of losing trades. So clearly you can see that the blue is a lot larger than the red, which means on average traders are winning on more trades. They have more winning trades than they have losing trades. Now, if we compare this back to this chart, remember, most traders are losing money. But yet, on a trade-by-trade basis, traders are winning on more trades than they're experiencing losing trades. So why is that the case? And it boils down to the risk-reward. It gets back to what I was saying, where they risk a lot to make a little. And on this particular chart, we have the red and the blue broken out a little bit differently. The most important bar on this chart is on the right-hand side. The red bar and the blue bar on the right-hand side. What the red bar says is 94. That means the average losing trade on an FXCM account during this time period, this 12-month time period, over these 12 million trades, the average losing trade was 94 pips. The average winning trade was 52 pips. So as you can see, traders are risking a lot just for a small amount of wins. They're risking almost 100 pips to collect 50 pips. And we want to try to reverse that. Now I've got another way that I'm going to digest this data. I'm going to break this down and unpack it for you. Those previous three charts that I shared with you is all FXCM data, FXCM traders and their behaviors, just the averages. So it could be good traders, it could be poor traders, it could be traders with a lot of money, traders with not a lot of money, traders that are using technical analysis, traders that are using fundamental analysis. All of those traders are mixed into one pot, and that's how we got those previous three charts. Well, now what we're going to do is we're going to take a specific trading strategy, a simple RSI trading strategy. So by a show of hands, how many of you are familiar with the relative strength index, the RSI, familiar with it, maybe even have traded with it before? Okay, so there's a few hands going up. And so the way that this strategy works is very simple. You'll notice along the bottom of the chart, I have an oscillator called the relative strength index. And as prices go up, it can indicate to us when the relative strength of that is getting too strong and considered to be overbought, and therefore prices are likely to return lower. And those are denoted by the red arrows here. So when the RSI crosses up above this top green line right here, this is the 70 mark, when the RSI crosses up above this line and crosses below, it's going to generate a sell signal according to this strategy. The blue portion along the bottom is the 30 mark. When the RSI crosses down below 30 and crosses back up above this lower green line, it's going to generate a buy signal. So what we did is we took two traders who are trading this exact same strategy, but there's one thing different that they're doing. and we're going to try to isolate the risk-to-reward ratio and see if we can learn something about the market. So just on the general mechanics of the strategy, you can see that this strategy does a reasonable job of picking tops and bottoms. So we've got these two traders, Trader Red and Trader Blue, and we're going to focus in on the risk-to-reward ratio. Trader Red is going to use a 1-to-1 risk-to-reward ratio, meaning for every $100 that Trader Red risks, Trader Red's going to look for at least $100 of profit. Trader Blue is not using a money management, account management technique like that. Trader Blue is just simply looking for the next trading signal and using that to close out the trade and reopen a new trade. So let's see, actually before we get to that chart, I did want to break down the risk-to-reward ratio because this is a very important concept for traders to understand. This is the genesis behind risking a little to try to make a lot. And risk-to-reward ratio is derived with, as a result of two components. You've got your risk component, your stop loss, and then you've got your profit target amount. And it generates a risk-to-reward ratio. So what I've got here in the first row, let's say we've got a trader that's risking 90 pips, very similar to the average FXCM trader. That same trader that's risking 90 pips is looking to take profits in about 45 pips. That means that for every 2 pips that they're risking, they've got 1 pip of potential reward. That's what the average FXCM trader is doing. That's not what we want to do, but that's what the average trader is doing. The second row is an example of a 1-to-1 risk-to-reward ratio. This is what Trader Red did on this strategy. We've got 115 pips of stop, 115 pips of risk, and 120 pips of profit potential, generating, when you divide them out, a 1-to-1 risk-to-reward ratio. The third row, 115 pips, and if I look for 230 pips of profit potential, that means I've got a 1-to-2 risk-to-reward ratio. And then lastly, it can be done in pips. It can also be done in dollar terms. So the last fourth row here, $115 of my risk. If I'm looking to profit by at least $345, that makes it a 1-to-3 risk-reward ratio. So on this chart, we want to try to do rows 2, 3, and 4. And we want to stay away from row 1, okay? So it doesn't matter what your stop loss is. It's that relationship between your stop loss and your take profit level when you're entering into your trades, okay? That's the important thing to take away here. So we go back to Trader Red and Trader Blue. Trader Red's using at least a 1-to-1 risk-reward ratio. Trader Blue is not. And so here, on their strategy, you can see that when the prices, in this case on the euro dollar, are trending sideways, not really making any progress one way or the other, said to be range bound. You'll notice that as this gets signals, it does a pretty good job of buying at the bottom and selling at the top. The problem here is if prices ever break out and if the euro dollar all of a sudden begins to trend, well, Trader Blue, who wasn't using the stop loss, is going to take on a very large losing trade. Whereas Trader Red would have had their stop loss triggered, would have walked away from the trade with a relatively small loss. And here's the result of their equity curves. Or actually, these aren't equity curves. These are a net profit. This is a back tested of those two traders on the same strategy. It's a 10-year period from 2001 to about 2011, so very long period. And the point behind this chart is not how much they made or lost. The point I want you to look at when you look at this chart is the relative location of the red line versus the blue line, okay? A couple of things. First of all, the red line is consistently above the blue line. And that simply means that Trader Red, who used a 1-to-1 risk-to-reward ratio, the results from Trader Red the net profits from Trader Red were slightly better over time, over any given period of time, than Trader Blue. The other thing is, notice that the swings, the ups and the downs on Trader Red, they're not as big, they're not as volatile as what Trader Blue experienced. So Trader Blue has much more dramatic swings to the upside, much more dramatic swings to the downside. So the path that Trader Red took was a bit smoother and ended up in a better location than Trader Blue. So again, this is the second test that we did. The first test was all the FXCM data, 12 million trades. Here we're taking the same strategy and we're breaking it down into two different types of traders, two different money management techniques, and this clearly shows that as long as we are looking to profit at least as much as we're risking, we end up in a slightly better place. Now, I've got one more chart that I'm going to show on this particular section. So if anybody has any questions about the charts so far, I'll take a couple of questions and then we're going to move on. We will have a Q&A coming up here at the end as well. So write down your questions and we'll get to those later. Is anybody having a question about these charts, the data that I've touched on so far? Because we're going to build on them here in a second. Anybody? Okay. All right. So we're going to move on. This was a test that I did back in September of 2009. What I did is I wanted to really test out this theory of risk to reward ratio. Is it possible that money management, account management, can actually wiggle you out of some bad trades? That was really what I was trying to test. And in order to do this, I thought, how am I going to figure this out? I created a strategy, I created a program. It's not that exciting. Basically, it buys on Monday, and then it sells on Tuesday. And then it buys on Wednesday, and then it sells on Thursday. And then it buys on Friday, and then it sells on Monday. So I created this program that was meant to put random entries out in the market. And then, depending upon those random entries, we would apply couple of different money management techniques to it and just see what the results were. And this is what the results are. So the numbers that you see here represent the average profit or loss per trade. Now, as you can imagine, on a strategy of that nature, where we're just putting random entries out in the market, I'm not expecting this to be profitable. That is not my goal. My goal is I wanted to see if there was any trends in the difference between the money management techniques. So on this strategy, when it goes out and it buys on Monday, it places a 50 pip stop. And then what I did is I adjusted the profit target to come up with 5 different tests. So the first test, 50 pip stop and a 17 pip profit target. So I risked a lot to make a little. And it averaged negative $53 per trade over a 2-year period. There were about 520 trades that were taken over that period of time. So there's a fair amount of trades that are going on. And again, on this strategy, there's no regard to technical analysis. There's no regard to trend. It's all about the money management associated with it. The second test is a 2-to-1 risk to reward ratio. That means that there was a 50 pip risk and a 25 pip profit potential. Really wasn't, it's not materially any different than the first one. I mean, they're essentially the same. The third test, the negative 47, negative $47 per trade. And this is a 1-to-1 risk to reward ratio. Risking 50 pips, looking to take profit at 50 pips, random entries into the market. This was on the euro dollar. This was back in 2007, 2008. So there were times the euro dollar was in a strong trend. Sometimes that trend was up. This thing is still taking buy and sell signals. It's going both ways. Still, nothing materially different. But the big thing to walk away is notice the left-hand side of the chart versus the right-hand side of the chart. On the right-hand side of the chart, I've got a plus 19 at a 1 to 3. I've got a negative 19 at a 1 to 2. Those are materially different than the left-hand side of the chart. And so look at this chart with regards to the right-hand side represents risking a little to profit a lot, and the left-hand side of the chart represents risking a lot to profit a little. And you can see there's a material difference between the two. And so that should help solidify the case that our data shows from FXCM that traders risk a lot to make a little, but yet if we turn that around and if we risk a little to try to profit a lot, then we could help bring some more stability to our trading, because here is a strategy that shows random entries into the market and it actually made money over a 2-year period. Now again, I'm not suggesting that you need to go out and make random entries into the market. Absolutely not. The point is that the results were better when we tried to risk a little to try to profit a lot. Okay? Any other questions on this chart? I'll take anybody have a question? Yes, sir.
Do you have any information about the results of using this result based on 1 to 4 and 1 to 5?
Okay, the question is, do I have any information about using a 1 to 4 or 1 to 5 risk reward ratio? And I do not. I just did it on these 5 tests right here, but I would expect it to be similar. What I would walk away with by looking at this chart is, is a 1 to 3 going to be better than using a 1 to 4? I don't know if that's going to make a huge difference one way or the other. The point is we want to try to risk a little to make a lot. Because naturally, if you go from a 1 to 3 to 1 to 4 risk reward ratio, your win ratio is actually going to drop. You're going to win on less trades. As a trader, it's tough to win on a small number of trades. So I'll take one more question, then we'll move into the other, the next section.
What indicator do you use to win 1 to 3?
What indicator to use on the 1 to 3? Okay, on this strategy that I did here, there was no strategy. There was no indicator. It was buying on Monday, selling on Tuesday at 9 a.m. Buy on Wednesday at 9 a.m., sell on Tuesday at 9 a.m. So there was no strategy behind it. That was the point, was to make it somewhat of a random, monkey stamping, or a cat walking across the keyboard type of thing. Okay, good question. All right, let's move into the next section. So I kind of laid out the case. Now again, if you guys have any more questions, you can just simply write those down, and we're going to come back. We're going to do more Q&A here towards the end. Okay, we'll collect up those pieces of paper. So now we're going to take a look at, we went from why is it the #1 mistake, or proving to you that I think it is the biggest mistake. Now, why is it that it happens? Why do people not do this? I mean, it sounds simple, right? Just try to risk a little to make a lot. But yet we have a hard time doing it. Really, the biggest reason is emotions. Sometimes we can be our own worst enemy. Yeah, that got a couple of chuckles. Here's what I found on traders, because we'll do, at Daily FX, we do several live webinars a week, and we talk about this type of thing. And we'll talk about specific strategies, and we got a whole host of topics that we cover. But we still have folks that they know what they need to do, they just simply don't do it. And it's because between our ears. Sometimes we don't have a plan. So we think that, we think that a certain currency, the euro, we've heard a lot about the sovereign debt crisis going on in Europe. And so we think that the euro should sell off. I mean, there's no way the euro can go up on this kind of news. And so then we go out and we sell the euro. But we really don't have a plan of how do we get in, when do we get in, when do we get out? Is there a point in time where, what we call in the United States, we call it the uncle point. Is there a point in time where, I don't want to be in this trade anymore? We should have that all figured out in advance before we enter into the trade. But too often, what I found out is that traders wait until they're in the trade, they hope for the best, and then when the worst happens, they find a way to try to wiggle out of it, and sometimes it ends up creating more problems. Sometimes we have pressure to be right. We want to be right. That's a human condition, is we want to be seen as an expert. We want to try to be right all of the time. But we don't have to be right all the time. This is one of the things that I actually like about foreign exchange trading, is that I don't have to be right all the time. But if I set up my risk to reward ratios so that I'm risking a little to make a lot, I could still be wrong half the time and still give myself the opportunity to grow my account. If I'm risking, for every pip that I'm risking, I'm looking to gain 2 pips. Do the math on that. It's a mathematical equation. So I would much rather take a 50% loss ratio than have to be right 80% of the time. Okay? The next one, the third one, revenge trading. So what revenge trading is so you enter into a trade, you get stopped out of the trade, maybe you lost some money on the trade, and then we see that the price is moving back into our favor, and we're like, doggone it, I knew that was going to happen. And so then you start entering back into that trade because you saw it move back in the direction you thought it was going to go. Well, I call that revenge trading. And it even gets me because when I get stopped out of a trade, it hurts me as well. And so I found myself get emotionally excited, sometimes to a bad way, when I get stopped out of a trade. So I have a rule that I use myself where once I get stopped out of a trade, even once I take profit on a trade, I don't trade that currency pair for another 24 hours. And that just allows me to cool off and sleep on it. I'll trade another currency, but I just won't trade that one. And then lack of confidence. So you may have a plan, you may know what to do, but you're not confident enough to be able to stick to your plan. And the recipe for this seems a little counterintuitive, but it's really pretty simple, and that's trade in the smallest trade size possible according to your strategy. That way it allows you to really test out the strategy and see for yourself the emotions that you experience before you get into the trade and before you start putting larger trade size on the line. So I found that to be very helpful, although people have a hard time implementing, as you can imagine, because we want to go out and we want to make money. We have a winning trade and we're like, oh man, if I would have traded my normal trade size. We're thinking about the profit and the loss, where in reality, if we don't have confidence in our strategy, we need to take a step back from that profit and loss, trade in the smallest trade size possible, and then that way that really allows us to focus in on the strategy. I've kind of gone over this a little bit as far as the how to avoid it portion, but basically it's the opposite end of why it is that we do it. So set it and forget it. Have a plan. Before you enter into the trade, have areas, have specific price points, have dollar amounts set of this is what I'm looking to make, this is what I'm looking to lose. And once it hits those points, then you reverse your trade at that point. Now, I'll be doing this next week as well while I'm here in Hong Kong. But one of the services that FXCM offers to clients with $50,000 or more is we'll do strategy consultations. And the second bullet point falls under that, where I'll sit down, it'll be over the phone or in person, and I'll ask the trader, I'll say, hey, describe to me how you make your buy and your sell decisions. What is it that you do? And so many times when people describe to me why they buy and sell and the decisions that they make, what I find is that oftentimes they have pretty good decisions. They have pretty good logic behind their strategy. It's just that there's one thing that's usually off a little bit. And that basically boils down to the point of if you have a good idea, usually see it through rather than abandoning the idea because you're simply up 20 pips and you're afraid to let those 20 pips turn into a loser, so we close out at plus 20 when in reality the market maybe had the potential for more. Okay? And then the last portion here, we do offer, like I mentioned a little bit ago, Daily FX Education Live webinars inside Daily FX Plus. It's a resource that's available to all live clients of FXCM. You just simply need your live account number and password in order to get in. So I've got a couple of examples that I'm going to get into now. And for this, I'm going to attempt to look at some charts. Before I get to the charts, I need to set it up for you, okay? So here is two graphs. The top graph is the Chinese inflation rate. The bottom graph is the Australian inflation rate. Now, these inflation rates are measured through the CPI, Consumer Price Index. Now, the reason I've chosen the CPI as the fundamental data point here today is because when it comes to the strength or the weakness of a currency, the interest rate has a significant impact on the investment into or out of that particular currency. And what influences that interest rate, CPI is one of those influencers that generally has a significant impact on the interest rate. So I've chosen this because if the CPI is high and rising, then that typically means we're going to see more investment going into those currencies. If we have a CPI, an inflation rate that's low or lowering, then we may see investment flee away from those currencies. So I've taken the data here, China on top, Australia on the bottom, and the reason that I've chosen China and Australia is because China is the largest trading partner with Australia. In Australian terms, China is the largest export destination. In terms of Australia, China is the largest importer into Australia as well. They do about, on those two items, importing and exporting, it's about 20 to 25% of Australia's imports and exports. So it's a significant amount. And so what we see here is that previous graph overlaid on top of each other. The red line represents China and their CPI reading. The black line represents Australia and their CPI reading. And when I was taking a look at this data, what I found out is that, you know what? Because China is such a large trading partner to Australia, whenever China slows down, of course it really has an impact on Australia and therefore could weaken the Australian dollar. Example of this is back in 2008. You'll notice that China peaked out here up at the top, immediately began to fall, and it was 1 quarter later when Australia peaked out and then began to fall. And then down in the bottom in 2009, China bottomed out, began to rise. Australia's inflation rate bottomed out and rose 1 quarter later. Well, we just recently saw China start to top, and this was back in the 3rd quarter of last year, so very fresh. And then, sure enough, Australia seems to be rounding out a top as well. So based on the inflation rates that we're seeing here, and the inflation rate in these two economies are arguably the higher of the more developed worlds, because the inflation rates are fairly high here, it looks like we have the potential for a slowdown. It may not be a massive sell-off, doesn't have to be, it could be just a simple slowdown. And because of the slowdown that may be going on in China, because of the slowdown that may bleed its way into the Australian economy, then the Australian dollar is possibly going to have pressure on it to the downside. And so there's a couple of different ways that we can place and trade this Australian dollar weakness. And the whole point here to get it back to is I want to share with you how we can implement using at least a 1-to-1 risk-reward ratio. That's the whole point. The first situation is going to be if oil is high, the price per barrel is high. It's remained elevated here for several months. If it continues to remain elevated, and if we think that Australia is going to weaken, then one potential trading opportunity could be to sell the Australian-Canadian cross pair, because Canada has a correlation to the price of oil. The reason that is because the United States takes a lot of oil, well, buys a lot of oil rather, we don't take, at least not that. We buy a lot of oil from Canada. Canada produces it, so therefore the higher the price per oil gets per barrel, then the more funds that are flowing into Canada. And so let's take a look at a chart and let's see if we could possibly look for an opportunity on the Australian-Canadian dollar. So here's a chart. This is up to date. And we could see that ever since October of 2008, prices on the Australian-Canadian dollar have been on an uptrend because prices are up above this black line. And so technically the prices are in an uptrend over the longer term. However, with oil on the rise and with Australia possibly weakening, we could see this move to the downside. And so let's look at some technical analysis and try to find an opportunity here where we can enter into a trade, a higher probability trade, while using at least a 1-to-1 risk-reward ratio. And a couple of things to note here. If I zoom in, and hopefully you guys at the back can see this, I've got this downward sloping purple dotted line, and this has been containing prices since the 1st of March. And so one thing that we could do is we could wait for prices to move up to this purple line, and we could make a sell trade near this purple line. That would help us time an entry. And then again, whatever we risk on the trade, we want to make sure if we're risking 100 pips, we want to look for at least 100 pips and possibly 200 pips of profit potential. I've also got these green lines out here as well. These green lines are around the 105.50 mark. And if prices were successful in pushing up into 105.50, I would become an interested seller. Don't know if that would happen, but if it does, I would be an interested seller. Because I have 1, 2, 3, 4, 5 occasions where prices pushed up to that level and it got rejected. So if we pushed up to that level again, I'd be interested in possibly selling, again, with at least a 1-to-1 risk-reward ratio. All right, let's move back. Let's move on here to another possibility. Okay, so we've talked about the China and the Australian relationship. Now, let's take a look here at the Australian dollar. So let's say China really starts to slow down. If China slows down, well, naturally, that could have an impact on the United States. That could have an impact on Europe because China is just a huge trading partner really with all parts of the world. And if the U.S. starts to slow down, well, then you've got an area in Europe where they've really been struggling with this European sovereign debt crisis. And they really need a healthy United States, they really need a healthy China to help them pull out of it. Okay? So imagine you're married, and you and your spouse both have jobs. You're doing a pretty good job, making decent money. And you have a lot of expenses, a lot of debt, and then all of a sudden one of you loses a job. It's going to be much more difficult for you to be able to maintain and pay off that debt than when you both had jobs and were making a lot of money. And that's the situation that we have here. If Europe continues to have good exports, a healthy economy in the United States where they can export to, if China can be a healthy economy where Europe can export a lot to, well, then there's going to be a lot of money going into Europe to help them process through these debts that they've accumulated. But if either of those economies slow down, then that could send this couple into harder times and possibly throw them over the edge. And if that happens, we could really see this risk-averse type of sentiment sell off. You'd see stock markets sell off. You would see interest rates rise in some of the less developed economies. And if that's the case, then this Australian US dollar, which tends to have a correlation to the stock markets, we would see that Australia US dollar move to the downside. So let's just take a quick look at that chart. And then we're going to be taking questions, Q&A here. So I want you guys to go ahead and write down your questions on a piece of paper, and then Iski and I think a few other people are going to go and collect them. You've already got some? Okay, awesome. But if you do have any more questions, just wave at Iski, sorry. Okay, here's the Australian US dollar. Same type of thing. Prices have been holding up above this black line, but I had a couple of TV interviews last week, and of course they were naturally, I was down in Sydney, and they were asking me about the Australian dollar. And the thing about the Australian dollar, it has been the weakest currency since the 1st of March. And it's digesting this previous uptrend, or perhaps this could be a global slowdown, a soft patch, and that traders are, taking profits and closing out their Australian positions. So here I've got the Australian US dollar. This is a daily chart, daily time frame, and So one thing I notice here, let me zoom in. Is I have this area where when prices push up into this area, it tends to get rejected. This is around the 104.50 level. So if we did get prices to push back higher to up to about 104.50, current price is around 103.70, so it's not too far away. That might be an area where I would look to sell. I'd be selling at a higher price. And I would place a stop maybe about 100 pips up above there, and then look for at least 200 pips of profit potential. So getting back and throwing it all together, mixing it all together, whenever we're looking for trades, we want to look for those opportunities where we're risking a little to try to make a lot. So in this case, I would be risking 100 pips to try to make 200 pips. And then with the fundamental story behind that, Australian dollar's been the weakest currency of the 8 major currencies since the 1st of March. China is slowing down, still very hot, but that demand seems to be slackening a little bit, and therefore it could put pressure on the Australian dollar to become lower valued because interest rates might be dropping in Australia. All right, so let me close this up, and then we'll get to some questions. At least close up this portion. Thank you, ma'am. There we go. All right, so the number one mistake traders make, they risk a lot to make a little. How do we avoid that mistake? Risk a little to make a lot. Just turn it around. Use at least, in a more practical sense, use at least a 1-to-1 risk-to-reward ratio. And like I mentioned very early on, I'm going to be doing an additional follow-up. I'm going to have more data. I'm going to have a different look at some data while I'm in the FXCM Asia office here in Hong Kong. It's over in Central. And I'll be doing a premium session next Tuesday and Wednesday. Okay? So the venue isn't near as big as what we have here. We have several hundred people here today. Because of the smaller venue, we made it available to those who open a brand new account with at least 2,000 US or 20,000 Hong Kong, or if you have a current account and you added 2,000 US or added 20,000 Hong Kong, then talk to one of the representatives and they can get you a seat, because I'm doing these Tuesday and Wednesday. I believe the time is 6 o'clock. So what I'm going to be doing is taking the next step in the traits of successful traders, looking at more data, and I'm actually going to have a strategy with specific buy and sell rules that I'm going to go over, and we're going to be talking about time of day and what the time of day, how that can impact a strategy. So that's intended to be a smaller class size. So if you are considering opening the account or adding additional funds, that's another bonus that you can get. Come see me next Tuesday and Wednesday. The last 2 bullet items here that I want to share with you as well. Whether you're going to attend the premium sessions next week or not, I would like for you to try your hand at implementing at least this 1-to-1 risk-reward ratio. And you can do so by taking down this particular website address, and any trading ideas that you see out there, go ahead and make a post of your trading idea, and I'll take a look at it and just provide you a little bit of feedback, you know, if you did a good job of using that 1-to-1 or better risk-reward ratio. So I want you to basically put this to practice yourself the way that I put it to practice with the Australian dollar just a few moments ago. Okay, let me grab some questions, and if you are continuing to have any questions, just wave at Iski, and she will come grab them. Okay. So, what's your recommended risk-to-reward ratio to us? Is it 1-to-2 or 1-to-3, or other ratios, say 1-to-2.5? Okay? I'm leaving that up to you. In my trading, there's 2 types of trades that I make. I do most of my trades where I'm in them for at least a couple of days out to a couple of weeks. On those trades, I use at least a 1 to 2 risk-reward ratio. Sometimes I will find a trading opportunity that's even 1 to 3. And it just so happens, since I have a chart, and I like to look at charts, I'll show you one here on the euro dollar. Anybody like the euro, like to trade the euro, have traded the euro? Show of hands. Okay, I guess you don't have to like the euro to trade it, right? And brushing up on my Chinese here a little bit. Okay. So I tweeted about this a couple of days ago, and when taking a look here at the euro dollar, and what I'm going to show you here is the potential for a 1 to 3 risk reward ratio. Doesn't mean it's going to be a winning trade. Of course, I have no idea if these are going to be winning trades, but what I'm looking for as a trader, a good opportunity at a good risk reward ratio. That's one thing that I want. And so here's the euro dollar, and if I just simply, oh, I got it covered, Iski. Yeah, no, I got it. If I just simply add some Fibonacci retracement levels, and this is one thing that I notice is that I'm getting very close to this upper line right here. This is oftentimes acts like resistance into the future, and this is around the 132.33 mark. And so Friday afternoon, we're getting pretty close to that. We're in the low 132s on the euro dollar. But if we push up into about the 132.33, you know, give or take 5 or 10 pips, that could be a good opportunity at a good risk-reward ratio. Because let's say it was 32.50. Let me use round numbers. And if we placed a stop around 3,400, well, the difference between 3,400 and 32.50 in a sell trade would be about 150 pips. And the profit potential on this type of a trade would be around near these lows of 126. So that would be risking 150 pips for the potential of 600 pips to the upside of profit. So that would be about a 1 to 3, maybe even a 1 to 4 risk reward ratio. When I see trades like that, I get excited. They're not always like that, though. Some trades are just 1 to 2. So to answer that question, on longer term trades, I look for a minimum of 1 to 2. And then on day trades, where I'm in and out the same day, I will use at least a 1 to 1. So my overall recommendation for you is use at least 1 to 1. And I tend to think that different ratios for different major pairs, for example, Euro, Aussie, and Yen, I think different levels of stop loss. So on one, it might be 50 pips. For another, it might be 100. But the ratios should still be the same. The difference, in my opinion, is whether you're doing more longer-term trading versus more shorter-term trading. Shorter-term trading is harder to get a 1 to 2 risk-reward ratio. So therefore, you need at least a 1 to 1. For every pip that you're risking, you have at least 1 pip of profit potential.
Just one more question. You can stay behind and answer the question. One more question, and you stay behind.
Are we out of time?
Yeah.
Oh, we're out of time. But I will be sticking around. I've got nowhere to go. I'm stuck in Hong Kong. Okay, so how do you know when to cut a loss? Sometimes after you put through a stop loss, it will come right up. Should we buy it back or not? Okay, that gets back to that revenge trading that I was talking about a little bit ago. Most of the time, I let it go to my stop loss or my take profit level. However, once I do get taken out of the trade, either at a profit or at a loss, I don't trade that pair again for at least 24 hours because it can be very painful. And actually, I don't even try to look at it because that just gets me all riled up too. I mean, how many times do you take profit on the trade? You've already bagged it, it's in your account, but then you still look at it because you're like, oh man, I wonder if it was going to continue going higher. Oh man, I could have gotten an extra 20 pips on that. I mean, let's face it, we're human. We want to know, did we get ourselves a good deal or not? And so we keep going back and looking. And what I realized is, it doesn't matter. I've already taken my PIPs. I was obviously happy with the PIPs that I took. And so then I try not to even look at it, because otherwise it will get me excited and more tempted to want to re-enter into those trades. So, all right, well, Iski says no more, or she will take me out and throttle me. So, but I do want to thank you guys very much. I will be sticking behind here. I'll be hanging, maybe up front, or perhaps even out just outside these doors here, out in the foyer area. So you're more than welcome to come up. I'd love to chat with you. We could talk about trading. We could talk about whatever interests you. And thank you guys very much for joining me here this morning. And I'm going to pass the mic over to Mr. Wilson.